Hello. Welcome to our next chapter, that is your impairment of asset, that is your IND AS 36. Little important chapter, please pay attention. Okay, so first of all, we'll start with what is impairment, how do you test impairment. So impairment is basically when there is a difference between the carrying value and your recovering value. Carrying value is the value which is shown in the books, and recoverable value is basically your net selling price or your value in use, that is your recoverable value. So if whenever you do impairment testing, you will be comparing carrying value, because that is what is shown in the books, and your recoverable value, because an asset is what? Future economic benefits. Future economic benefits is basically what will be the recoverable value of the asset. That means what is the asset actually worth today based on the benefit that it will be giving me in the future. So therefore your carrying value is your cost minus your accumulated depreciation. Because you do impairment testing at year end, you will also include your current year depreciation. Okay, so it will be the cost, because this is done at the end of the year. So therefore it is necessary that you also have to give effect of depreciation that is done throughout during the current year. So that is cost minus accumulated depreciation becomes your carrying value. Recoverable value is made of two parts. First is your net selling price. And second is your value in use. So when we say net selling price is estimated selling price minus cost to sell. Estimated selling price, that means if you think that you can sell this asset at rupees 100, but you will also have to incur some cost. You will also have to incur some cost to sell the asset, say for example rupees 10. So therefore your net selling price will only come to rupees 90. This can include your dismantling cost, your packaging cost, any legal fees. Now, what is your value in use? What is your value in use? Your value in use is your present value of future inflow. Present value of future inflow. So, whatever benefits the asset will give you, that is your future inflow. You will have to bring it to present value. Now, how do you bring it to present value? You will be using your pre-tax weighted average cost of capital. Pre-tax WACC you will be using. Okay. So recoverable value, net selling price, or value in use, whichever is higher, you compare it with carrying value. If your recoverable value is less than your carrying value, say for example in this case your carrying value is 1000 rupees, and your recoverable value comes to say rupees 800, so you will have to give a impairment of rupees 200, so that this becomes equal to your recoverable value. However, if your recoverable value say came to 1800, in such a case no effect will be given and it will be shown at 1000 in your books. Okay, now in this case, the one that we discussed, so the one where we discussed where we reduce 200, when we say we will be reducing 200, basically where will we be giving this 200 effect? So impairment loss, this 200 rupees is your impairment loss, that is loss due to impairment, which we say. So this will be first written off against any revaluation reserve. If you have any revaluation reserve, first it will be written off against revaluation reserve, and then it will be written against your P&L, that is your profit and loss. When to impair? So some assets have to be impaired annually, some have to be impaired only when you feel oh, maybe there are some conditions. So any intangible asset with indefinite life, any intangible asset under development and goodwill. So all these assets have to be tested annually for impairment, and all others have to be tested only when indicators exist. There are certain indicators which you feel that because of which there might be conditions for impairment, only then you test them. Okay, so this was your impairment. Once you've impaired, sir, can I also reverse this impairment? Is there an option available? Answer is yes, you can always also reverse impairment, only when your carrying value or recoverable value, whichever is lower. So you have to first calculate carrying value ignoring impairment, and your recoverable value to whichever is lower, this becomes your A. Then next is carrying value post impairment. Okay, so you have to assume that what would be my carrying value of this asset had there been no impairment. On this asset, what would be my carrying value and what is my recoverable value today? Whichever is lower, that becomes your A. Next is B is your carrying value post impairment. Carrying value post impairment is your B. That means B is what is being shown in books today. This is basically your book value today, what is being shown in books. So therefore you compare what is being shown in books with whichever is lower, that is carrying value had there been no impairment or recoverable value. Whichever is lower, you subtract this and only that much portion will you be allowed to impair. So reversal can only be done if there is an increase in earning or service potential of the asset. Only if there is an increase in the earning and service potential of the asset. Reversal cannot be done merely due to passage of time. That means there is no advancement in asset, there is no change in asset just because of time. Just because of time there is a increase. If the, just because of time there is a increase in the value of asset, then we will not be doing impairment. When I said just because, it reminded me of that meme, just because. Okay. Next is the cash generating unit. So cash generating unit, of which we also call as your CGU. So first we'll understand what is a CGU, and then we'll identify, and then we'll understand how to impair. So cash generating unit is the smallest identifiable group of assets. Smallest identifiable group of assets that generate cash inflows independent from other group. That means some certain assets individually can generate cash flows and they don't care what other assets in the same company are doing. This is the CGU, that is your cash generating unit. Break the name, cash generating unit. That means smallest identifiable unit group of assets capable of generating independent cash flows from others. If there is no impairment in CGU, then there will be no impairment in any asset within the CGU either. That means, what do you understand? CGU is basically a family. CGU is basically a family of, say for example, you, your dad, your mom, and your sibling. So if all four of you, if there is, so we will first calculate carrying value and recoverable value, all four taken together. If we do not see any need for impairment as a whole, then there will be no impairment in any particular either. Understood? Only and only if we see that there is an impairment need for CGU as a whole, only then we will be impairing individual assets of the CGU. Otherwise, if the CGU does not need impairment, we will not be impairing any asset within the CGU. Okay. This includes liabilities in CGU, those which are required. Example, your decommissioning provision. Okay. So this is a liability. So your CGU also includes not only assets but also your liabilities. Okay. Now next is allocation of impairment loss in CGU. How do you allocate impairment loss in a cash generating unit? So first is you calculate the CV, that is your carrying value. You calculate first is the carrying value of CGU, that is carrying value of individual asset plus allocable goodwill and corporate assets. So say for example you have four assets, asset A, B, C and D, and these are all part of a CGU. So carrying value of individual assets you add. Okay. Then you add allocable goodwill. Some goodwill that will be, this will be given in the question. You add that, and any corporate asset will also be added. This becomes the carrying value of the CGU as a whole. Next is you calculate what is the recoverable value of the CGU. This will be given to you in the question. You check for impairment. That means you compare 1 and 2. That means if your recoverable value is less than the carrying value, only then will there be impairment. Now, where will, how will this be impaired? That means, where will I write this off from? So first this will be written off against goodwill. So allocable goodwill, whichever this is, first it will be written off from this goodwill, because goodwill is basically an intangible asset that gives you no return. So therefore, first of all, we eliminate goodwill. Remove this. Balance will be written off against individual assets or your corporate assets in the ratio of carrying value. Okay, so first of all, you finish goodwill. That means the second part that we added, first of all, you finish goodwill. If goodwill is completed, then you allocate. Then you allocate this in the ratio of their individual carrying value. Great. This is your corporate asset. Okay, so you bifurcate this. You divide this in the ratio of their carrying value. So carrying value, but one more thing. So now what happens? Let me try to make it a little cleaner. ठीक है, we'll do a small little example. ठीक है, तो say for example you have 4 assets, or okay, let's do with 3. You have 3 assets whose carrying value is say rupees 100, say rupees let's try 100 only. Okay, so for ease of calculation, ठीक है, you have 3 assets whose carrying value is asset whose recoverable value of A is 400. नहीं, we'll have to do recoverable value little lower ना. ठीक है, so over here recoverable value is 200, recoverable value of this is 20, and recoverable value of this is 20. ठीक है, recoverable value of this last one is 50. So in such a case what happens, your total recoverable value comes to how much? Over here it comes to 270, and your total carrying value comes to 300. So now recoverable value is less than carrying value, correct? So basically there has to be an impairment of 30 rupees. So now this 30 rupees, what do they say? There is, okay, so we've abhi ke liye I'm ignoring any goodwill, corporate asset. We're just focusing on your different types of assets. So first of all, we calculated carrying value of CGU, that is your 300. Then we calculated recoverable value of CGU, that is 270. Third we did is check for impairment, that is the impairment of 30 rupees. Now what do they say? Allocate first against goodwill. Okay, we don't have goodwill, this part is done. Balance to be written off against individual assets. So this 30 rupees has to be written off from these individual assets. Okay, now what does it say? Carrying value of individual assets. So otherwise this 30 rupees will be bifurcated in this carrying value, correct? So this 30 rupees will be bifurcated equally since all of them are 100. So basically A should be subtracted by 10, B should be subtracted by 10, basically impaired by 10, and C also should be impaired by 10. But what does this say? Carrying value of individual assets should not fall below the recoverable value. Understood? So if we subtract 10, if we subtract 10 from this, will it fall below the recoverable value? No. If we subtract 10 from C, will it fall below the recoverable value? No. If we subtract 10 from A, will it fall below the recoverable value? No. Okay, so we are allowed to do this. But say for example, if this recoverable value was, say for example, 100. Okay, so now to bring it to 170, we'll have to assume this is 120. So carrying value of individual assets should not fall below, the recoverable value. In such a case, the entire question remains same. Okay. So this 30 rupees, can we subtract 10 from A? Because if we subtract 10 from A, this carrying value from 100 will change to what? 90. But what does it say? Carrying value of individual assets should not fall below the recoverable value. Recoverable value is how much? 100. Therefore, reduce such balance from other assets in their carrying value ratio post first level of impairment. Okay. So therefore, we cannot subtract this 10 rupees from A. Therefore, we will have to subtract 15 rupees from B and 15 rupees from C. Therefore, A will not be taking any share because after impairment, carrying value of A of 100 will fall below the recoverable value of A, that is 100. So 90 will become less than 100. Therefore, we will not be allowed to do this. Okay, I hope this is clear with this example. Okay, coming to the next part, that is impairment testing for unallocable corporate assets. So there are two types of corporate assets. First is allocable, second is your unallocable. So what you have to understand over here also, this corporate asset was allocable. Okay, so how do you do impairment testing for unallocable corporate assets? So first of all, you ignore the unallocable corporate asset. Ignore the unallocable corporate asset. You allocate the carrying value of allocable corporate asset to smaller CGUs. You allocate the carrying value of allocable corporate asset, but you ignore the unallocable corporate asset. Second, check impairment in smaller CGU. Check impairment in smaller CGU. This is the revised carrying value. That is your carrying value, individual asset plus allocable asset versus your recoverable value. We have ignored the unallocable asset. Third, carrying value of CGU as a whole will be your revised carrying value plus carrying value of your unallocable corporate asset. Now you do CGU as a whole, and you compare recoverable value of the CGU. If the impairment calculated in step 3, so the impairment that is calculated in step 3 will be written off against the unallocable asset. Okay, so whatever impairment you calculate in step 3, that will be written off against the unallocable asset. And I think with this we are done with this chapter, and I will see you in the next IND AS, that is IND AS 37.